Welcome to PwC IFRS Talks, your source of all things IFRS, technical accounting matters, business issues, current standard setting, and regulatory updates. I'm your host, Ruth Preedy. In today's episode, we're doing a year-end reminders podcast for everyone to get ready for their year-end financials. And I'm very lucky to be joined by two of our regular favourites, Sandra Thompson and Tony DeBell. Welcome back. So Sandra, turning first to you, we've got lots of new standards, or two big new standards this year. You're specifically interested in IFRS 9. Could you start with things people need to think about for year end, maybe with corporates?
Yeah, I'll start with the corporate. So you say very much a hot topic, and we do expect regulators to focus on this. I think some corporates are still perhaps minded to think, well, IFRS 9 is really for banks. They've got big loan books, so surely it's not material for me, humble corporate, is it? And I think the answer is, well, it may or may not be, but there are some other aspects of IFRS 9 not to forget, and that's what I'm going to run through now. So the first is debt modifications. This is a case where a company has an outstanding borrowing liability and then renegotiates that liability, changes the terms, changes the cash flows in a way that's not so significant that it's accounting derecognition. It's still the same liability. Under IAS 39, most companies would have spread forward the impact of doing that. It's the difference between the old and new cash flows. They would have spread forward by adjusting the EIR. Under IFRS 9, it's clear you don't do that. You take a gain or loss at the time of the modification and you do not adjust the EIR going forwards. Now, given IFRS 9's retrospective, if you did such a debt renegotiation in the past and the debt's still on balance sheet when you move to IFRS 9, that will have an impact. So don't forget that impact can be big. These tend to be large one-off transactions, but sometimes the impact is big. The next one I talk about, IFRS 9 applies to a lot of financial assets, not just loans of banks. A few I'll particularly pick out. Loans to associates and joint ventures are in the scope of IFRS 9. You need to do IFRS 9's impairment model for them. Similarly, contract assets under IFRS 15, in some industries they can be pretty material balances. Those you need to do IFRS 9's impairment for. And similarly in separate financial statements, intragroup loans, so loans to subsidiaries or fellow members of the group. And those can be some of the hardest to actually do IFRS 9 impairment for, but they can be big numbers. So it's not just loan books and trade receivables, the impact may be not material, not for some of these other items. The next one is equity investments. Many companies have holdings of shares in other companies, sometimes called strategic investments. Those holdings are not big enough to be associates or joint venture holdings, so they've been in IAS 39, now moving to IFRS 9. Under IAS 39, an unquoted equity investment that could not be reliably measured would be at cost. Under IFRS 9, that's no longer the case. The cost measurement has gone, so they will have to be at fair value. Some companies have held these stakes for many years. Now, the fair value can be judgmental, but it's almost certainly not the cost number that was acquired many years ago, so that's another one to be aware of. And then finally, deferred tax.
Never forget tax.
Yeah, well, all of the above probably have a deferred tax impact, one to think about. And I have reviewed some templates that have done a very good job on IFRS 9 but forgotten the deferred tax, so don't forget the deferred tax. And indeed, some, going back to is it material, I think some regulators thinking if it's not material it would be helpful to say that, so that might be something to think about. Which brings me neatly onto disclosures. Clearly accounting policies need to change. Impairment's the obvious one, but don't forget your accounting policy on debt modifications or holdings of equities. They also need to be changed. And think about the options and choices that you've adopted. So there is a simplified impairment model for trade receivables, lease receivables and contract assets. Have you used it? Need to say it. With the equity investments at fair value, you have a choice between fair value OCI or fair value for P&L. This is what you've done. Sticking on equity investments, those that are being fair valued for the first time, almost certainly level 3 fair values, so you'll pick up the level 3 fair value disclosures. And then last but by no means least,
more disclosure, come on.
Hedge accounting. So there are lots of new disclosures around hedge accounting. One particular one I'd like to focus on, there is a requirement to disclose the average hedged rate and the timing of hedges. That's new, most companies have not done that under IAS 39. It can be seen as commercially sensitive. Now, you can do it for an average rate and you can aggregate similar kinds of risks and hedges, but there is no commercial sensitivity exemption in that disclosure in IFRS 7, so it does need to be given.
Yeah, oh my word. So lots of things. I must admit that's really helpful, because for corporates I do think they think, oh, I don't need to worry about it too much, but there's so many things that get easily overlooked and forgotten to be disclosed, so really helpful. What about banks?
Yeah, well, clearly banks.
Yeah.
I think banks are generally pretty well prepared for
Yeah.
IFRS 9. Clearly they know it's coming, they know it's going to be an area of regulatory focus. So probably going to major more on disclosures. I'll start with multiple economic scenarios.
Sounds easy.
It sounds easy, doesn't it? Yeah. I think this is probably the single bit of IFRS 9 that's been caused the most discussion, I think, and been one of the ones that's had the most effort. Now, there is no one right way to do multiple economic scenarios. And so I think, therefore, the emphasis is around disclosure. And it comes to telling your story. How many scenarios? What were they? Which ones did you pick? How did you weight them? There's no one right way. How did you reflect the non-linearities? Because that's really what this is about. And in some circumstances, that's been done via an overlay rather than the main model. We'll come on to Brexit later, but a couple of banks in the UK certainly have put in overlays for a hard Brexit. Perfectly acceptable. But telling the story about what you've done. Some of the UK banks have actually done a very good job of setting out in a tabular or graphical format what the various scenarios are. So often there's a base case and then there's a number of upsides and downsides. And actually showing what's the GDP for each, what's the unemployment for each, what's interest rate assumptions for each. That can be very helpful. So think about good disclosures there. The next one I'll pick on is changes to classification and measurement. Now, when I say that, most people automatically think, well, what's failed SPPI? But actually, some of the bigger changes that are coming through are not failed SPPI. They're changes to business model. And again, I'll pick on a couple. So one is banks' liquidity portfolios. Those are pretty much all available for sale under IAS 39. Moving to IFRS 9, it really depends on what your business model is and how the business model is managed, and they can differ between banks. So some of banks' liquidity portfolios are moving to held to collect, amortised costs. Some are staying fair value through OCI, potentially even fair value P&L. And we are seeing some diversity in where banks are landing. That's not necessarily wrong. They have different ways of managing these assets. But because of that will probably get some regulatory process. So being clear on where your liquidity book has ended up. And then the next one I'll pick is fair value option. When you move to IFRS 9, opportunities to redo fair value options, and some banks have. And again, the impact can be material. So being clear on what's been done and why. Yeah. The final one I'll pick up, going back to impairment, is what's called stage 3 or credit impaired assets. Under IAS 39, many banks did not build future sales of those assets in. Under IFRS 9, if selling a defaulted asset is one of your recovery mechanisms, it's the way you recover what you can from that asset, then that is included in the ECL IFRS 9 impairment number. And that's caused some changes between the IAS 39 impaired number and the IFRS 9. And certainly we're seeing some regulators looking for a reconciliation between the non-performing loans for capital purposes and the IFRS 9 stage 3 assets. So that's accounting.
Brilliant.
Presentation disclosure. My top one has to be interest income on items at fair value through P&L. So under IAS 39, again, many banks in their interest income had some interest-like number for things like derivatives and other items at fair value through P&L, perhaps fair value option assets. There was a consequential amendment made by IFRS 9 to IAS 1 and subsequent IFRIC agenda decision. It's clear the top line of the income statement needs to be interest income on things at amortised cost and fair value OCI, so excluding interest on anything at fair value through P&L. Now, we would allow you to put a second line item in, but you have to have that separate line item with no interest on items at fair value through P&L. Don't miss that. It's an easy win for a regulator, quite frankly. Think about notes. The notes are likely not to be comparable. Pretty much all banks have not restated comparatives. So, you'd have available for sale in your comparative that isn't there in your IFRS 9 numbers. Similarly, you'll have impairment numbers calculated on very different bases. So think of a way to explain what's gone on and not give the impression these are comparable when they're not. Finally, expected credit loss sensitivity is still a bit of an open area, but think about giving sensitivities. There is that paragraph in IAS 1, and there are different ways to do that. One way we are seeing is some banks disclosing the impact of the base case as if that were the only scenario. It's not the only way, or perhaps the impact of different house price assumptions, for example. Impact on capital, not required by IFRS 9. The market wants it. Regulators are looking for it. And then finally, IFRS 9 hedge accounting, same messages for corporates. There are new hedge accounting disclosures. Whether or not you've adopted IFRS 9's hedge accounting, the disclosures still apply. So don't forget your hedge accounting disclosures.
Don't forget the disclosures as well. And Sandra, I think whenever I'm reviewing accounts and almost trying to help people improve their disclosure, everyone always wants examples.
Yeah.
Is there any examples out there or things people can look at?
Yeah, I mean, some of the best examples have been either the UK banks, and they've done transition reports, which are pretty good, particularly on ECL. And the Canadian banks have the dubious privilege of going first with IFRS 9.
Lucky them.
So they already have reported under IFRS 9, and there are some good disclosures in some of the Canadian banks. So I'd recommend having a look at those two sources.
Brilliant. Okay, so moving away from IFRS 9, maybe not as much disclosure, but still a little bit. We've got IFRS 16, which isn't effective yet, but we still need to say something. So what do people need to do for that one?
Yeah, and just a quick recap, because we did cover this following our last update. So, as you say, IFRS 16 is not mandatory, and most people haven't early adopted because they've got 9 and 15 to go, but there are some disclosures. One particular one, when companies move to IFRS 16, if they've adopted a simplified transition, there's a requirement to reconcile the IAS 17 lease commitments note that exists today to the new IFRS 16 lease liability. Now, that means this is the year to get your IFRS 17 lease commitment note right.
Yeah.
Now, there are some valid reconciling items, but there are also some items we would not expect to be reconciling items. For example, make sure you've got your leases included. There are some changes to scope, but not many. Make sure you've excluded non-lease components in your IFRS 17 lease commitments, and think about extension options. So make sure you've got good processes and controls in place on that. And the other one is one we always have, which is the IS 8 disclosure about standards that are not yet effective. Now, bear in mind, by the time companies do their financial statements for 2018, we will be into the period of adoption of IFRS 16. So there's certainly an expectation from regulators that many companies will be able to quantify the impact of IFRS 16. Not enough just to say we're still considering. That may not be a number, it may still be a range, but think about, can you quantify the impact? If it's reasonably estimable, you should be doing that. And then, as ever, what choices will you make? The low value assets exemption, how will you do transition, and what are the key judgments? It might be lease term, might be discount rate. So make it meaningful, not just boilerplate.
Brilliant. Thank you very much. Okay, so thanks very much, Sandra. Now over to you, Tony. Other big new standard, we don't want to forget it. IFRS 15, what do we need to think about for year end?
Well, of course, there's no prospect that I'll forget about IFRS 15. It's been around for a long time now, and my sense is that most companies are largely through the transition project, identifying the differences with their previous revenue policies and settling on the impact of IFRS 15. And so now companies are turning their minds to disclosure. And so rather than talking about some of the technical aspects of IFRS 15, I thought today I would talk about some things that management might like to think about in the context of disclosure. The thing about IFRS 15 is that for some companies it's material. For other companies, the accounting outcome might not be very different to the accounting that's been applied under the previous standard. But the thought process might be different, or the judgments that management needs to make to get to its accounting might be different. And I think that's something that the users of the financial statements need to understand. The sense I get from looking at the way regulators have looked at interim financial statements, or the way regulators have looked at early adopters, and my own experience looking at interim financial reports this year has been that companies don't necessarily do a good job of explaining how they got from where they were before to where they are now. Not necessarily anything wrong with the accounting. People have done a very good job identifying differences under IFRS 15 and what the new accounting policies should be. But maybe they could do a better job of explaining specifically in the context of that company the impact that IFRS 15 has had. And so I think my view is that management should focus on telling its own story. So focus on the principal revenue streams and explain the impact that IFRS 15 has had. So for each revenue stream, what is it that gets delivered to customers? Putting it in IFRS 15 speak, what are the performance obligations? Explain when those goods or services are delivered to customers? What's the point at which revenue is recognised? Because that's an area where IFRS 15 can give you a different answer. There's different guidance for deciding whether your revenue over time or revenue at a point in time. Explain how much revenue is recognised. So again, in IFRS 15 speak, what's the transaction price? Because that's another area of variable consideration where the accounting outcome might be different. So focus on telling the company's story, explain why there are differences, or explain why there are not differences. The options that are taken on transition can have a significant effect, particularly in 2018. And this is an area where regulators have particularly focused and emphasised, particularly if entities are adopting the modified retrospective approach, that there are some very specific disclosure requirements. So it's important to explain what transition options were taken, what practical expedients were applied and so forth, and what impact that had on the 2018 financial statements. Finally, and moving on from the impact of transition to IFRS 15, there are much more extensive disclosure requirements in that standard than there were in the previous revenue recognition standards. And so it's important that management focuses on being able to make all of the required disclosures. A couple of examples. IFRS 15 requires disaggregated information about revenue. That disaggregation may well be in more detail than was required by the previous revenue standards and more detail than is required by the segment reporting standard. So just need to think about, what does IFRS 15 require? Is it more than I've given before? And secondly, the standard requires information about the transaction price that's allocated to performance obligations that will be satisfied in the future. Again, that's a new disclosure. I think if I had to leave people with two messages thinking about the disclosures in IFRS 15, one would be, tell your own story. So make the disclosures about the new revenue policies, about the impact of transition and so forth in a way that is specific to the company and allows the users of the financial statements to understand the impact on the company. And secondly is for management to be aware that they need to collect all the information to be able to make the new disclosures. So they might need to be collecting some information that they weren't collecting previously.
Brilliant, thank you, Tony. Okay, so moving on to our next topic, Brexit is obviously in the press lots at the moment. And there's lots of uncertainty. We're not sure what's going to happen. I think that will still be the same case when this goes out. So Tony, what do people do in terms of accounting?
Yeah, this is a really good question. Those of you that have been following the process of the UK's withdrawal from the EU will be aware that the negotiations, the debate, the discussions continue. At the moment, there is a lack of certainty about what the final outcome will be. And my sense is that the discussions and the debate and the negotiations are going to continue into next year. I suspect that in many cases, when entities come around to approving their financial statements, there is still going to be a level of uncertainty. Now, that potentially has an impact across a range of accounting areas. And I'd like to begin by saying that I don't think you can just ignore it. So it's a relatively significant event. Something is going to happen. We may be not entirely sure what, but there will potentially be an effect on future cash flows, for example, in the context of impairment tests. And I don't think that management can just ignore it. It's something that management has to think about and decide what accounting is appropriate across, as I say, a fairly wide range of accounting issues. The first one that immediately springs to mind, or always immediately springs to my mind at least, is the accounting for deferred tax.
Me and Sandra have a little sleep in the corner while you talk about this one.
So there will be tax consequences of Brexit. So when it finally happens, there will be some transactions between entities in the EU and entities in the UK that will no longer be subject to existing EU tax reliefs. So, for example, at the moment, dividends between entities within the EU are not subject to withholding tax. Once the EU law ceases to apply, then it might be that a parent company in the UK will suffer withholding tax on a dividend from a subsidiary within the EU. Or it may be that group reorganisations that involve entities in the EU and in the UK will become taxable. So when the reliefs cease to apply, there is going to be an implication for deferred taxes. and there may be a need to recognise some additional deferred tax liabilities. So the question is, when does that get reflected? Guidance in IAS 12 says that you account for the impact of changes in tax law when they've been enacted or substantively enacted. This is a very unusual situation. So you're normally looking at the situation in one country, and you look at that country's legal process when is a tax law substantively enacted. This is something that involves more than 25 countries. And so it's a different situation. What is clear is that the process is not finished. We don't know what's going to happen next. We don't know what the final outcome is going to be, but the process is clearly not finished. And for that reason, our view remains that it is too early to be accounting for the deferred tax implications of those types of transactions no longer being subject to the rules that apply between EU members. So I think that's the first thing. I think an area that is also important is the implications for financial and non-financial asset impairment, and maybe ask Sandra for a view.
You're doing all my work for me, Tony. I'll pass over to Sandra.
Yeah, thanks very much, Tony. Unfortunately, that is not the same message I'm about to give for financial and non-financial and asset impairment, and actually it's similar for insurance liabilities. So if I kick off. So if we start with financial impairment, IFRS 9 is clearly a forward-looking model, and it clearly envisages you may need to use multiple different scenarios, and if ever you were to look forward and think there might be multiple scenarios, I think Brexit is certainly in that category. Now, there's probably no one right way to do this. I will just reiterate what Tony said. There is a wrong way, which is to pretend it's not happening. So you do need to make a reasonable estimate that includes the impact of Brexit. Indeed, if you think about how you might model IFRS 9, you're probably going to be looking forward doing things like estimates of GDP and unemployment and interest rates. Those are all going to be impacted by Brexit. So you have to do something. How might you do it? Well, you certainly could model different scenarios, different Brexit outcomes, if you like, and then probability weight them. That would be an acceptable way. Often it's quite hard. If you look at how banks have done IFRS 9, their modelling process isn't particularly amenable to doing that. So there's probably some degree of Brexit in their models when they put those assumptions in. Maybe you might think about doing an overlay for a hard Brexit. We've seen a couple of UK banks do that. Overlays, again, is another perfectly acceptable way to do it. Be careful not to double count. As I said, there's probably some element of Brexit already baked into the modelling you've done. So make sure if you do an overlay, it's an additional overlay. But yeah, that's certainly acceptable as well. So I guess the main message is there's probably not one right way, but you need to think about it, and modelling different scenarios is fully consistent with IFRS 9. If we move on to non-financial impairment, things like goodwill and intangible assets, similar message. You are projecting future cash flows and you're looking at an appropriate discount rate to apply to those cash flows. When you do that projection, you've got to make certain assumptions, and Brexit will play into those assumptions. Again, you could think about different possible outcomes and how that would impact your cash flows. That's a way to do it. But again, you need to land something, and probably a similar message around measurement of insurance liabilities as well.
Never forget insurance. And Tony, just turning back to you, obviously we always talk about this, but disclosure is going to be important. What should people be thinking about?
I think disclosure is particularly important here because one of the things that disclosure can do is to provide information about the assumptions management has made and the potential consequences of the future being different to those assumptions. And that seems to me to be particularly relevant in the context of Brexit. At the moment, we just don't know what's going to happen. There may be developments after the end of the year before a set of financial statements are approved. There may be developments after financial statements are approved. The only thing I think at the moment that seems to be clear is that the UK is leaving the EU on the 29th of March next year. So there is a high level of uncertainty. And that makes disclosure of what management has done and the consequences if the future turns out differently important. And so, perhaps picking up on a couple of the things Sandra said, it's important to explain the approach that management has adopted, for example, to financial asset impairment or to non-financial asset impairment. Explain the assumptions that have been made, how has management thought about the potential implications of Brexit, and then explain how the accounting might be different if the future turns out to be a little bit different to the way management envisaged it. And I think that's something that is likely to attract a lot of regulator focus. So it's important to think about the assumptions that have been made and the consequences if the future just looks different.
And is this just obviously it's big in the UK because it impacts us, but is this just a UK consideration?
No, it's not. Clearly companies elsewhere in the EU are going to be affected. The impact might not be so great as for some companies in the UK, but there will be an impact in the rest of the EU. But this will also affect any, for example, parent company with a subsidiary in the UK or in the EU. So it's not just a UK issue. It's not something that other entities around the world can ignore. So if you have a large company in the United States or Canada or Australia or Hong Kong that has a subsidiary in the UK, then management at the group level is going to have to consider those issues and the impact they have as they filter up through the consolidation into the group financial statements.
Brilliant, thank you. So key thing I think on Brexit, don't ignore it. You've got to say something and explain it a little bit.
Yep.
Moving maybe to some other year-end hot topics and I suppose specifically around what regulators are looking at. Is there anything from a regulator perspective you'd like to share with us?
Yeah, there's one other thing that it's probably worth mentioning, and that's just to give a sense of the areas where I think regulators generally are going to have an interest. And one of the things that the umbrella European securities regulator, ESMA, does every year is to issue what it calls its enforcement priorities. And that's a brief summary of the areas that ESMA expects its constituent national enforcers to focus on during the reviews of financial statements that will be prepared over this year-end period. ESMA published this a little while ago, and it focuses on the areas that you might expect it to focus on. So some of the things that we've talked about on this podcast, the impact of the new standards, the impact or the potential impact or the expected impact of IFRS 9. I think that's something that the regulator is going to focus on. ESMA's given us a heads up they intend to focus on Brexit and emphasise the need to make clear disclosures about what has happened and what the sensitivity might be. One of the things that ESMA has pointed out specifically is to think about the impact of all of this stuff on alternative performance measures. So ESMA has some guidance on alternative performance measures that are published outside of financial statements. And it's encouraged entities to pay particular attention to the impact of the new standards on those alternative performance measures. And the last thing that I thought I would mention, partly because it's an issue that I deal with, even dealt with in a previous podcast, which is hyperinflation accounting.
Yeah.
And ESMA has reminded entities that Argentina became hyperinflationary in 2018. And to the extent that entities in the EU have a material subsidiary in Argentina or a material business in Argentina, they need to explain clearly the consequences of the impact of adopting IAS 29, the hyperinflation standard, for the first time.
Brilliant. And like Tony said there, we've got a whole podcast on how to adopt IAS 29 for the first time. So if you want more details, you can listen to that. So thank you very much for joining us today. Thanks for Tony and Sandra for giving us an update on what to think about for our year-end accounting. I've been your host, Ruth Preedy. Happy accounting. The preceding programme was brought to you by PricewaterhouseCoopers LLP. This content is for general information purposes and is not a substitute for consultation with professional advisors.